Vanguard's S&P 500 VOO and the Nasdaq 100 QQQs are crashing down big time as of recently, and the biggest question for ETF and even dividend investors is if we are heading for a recession or full-on stock market crash. Now, a stock market crash is a sudden and dramatic decline of stock prices, usually over double digits over a short period of time. And a recession is basically a decrease or contraction of economic activity. So with all that in mind, in this video, I'm going to provide a complete breakdown of how to buy ETFs and dividend stocks in a recession, with two different buying strategies that I personally follow in my over $100,000 investing portfolio. I'll also touch on what causes stocks and ETFs to go up or down in price, and what happens in the long run when you apply my two different buying strategies. So without further ado, let's get started. There are four main reasons on what causes ETFs and even dividend stocks to go up or down in price. And the first is earnings, mostly from large cap stocks, because bad earnings reports from large companies can cause the stock market to go down, but also the stock market can go up if these companies report good and strong financial earnings, since these large cap companies are heavily weighted in ETFs and index funds, and they also provide a good indicator of the health of the economy. The second reason is the Federal Reserve from either increasing interest rates or decreasing interest rates to combat inflation or to boost the economy. The third is economic data such as CPI data or inflation numbers that roll out monthly and job reports. And last but not least is geopolitics such as rumors of wars and global conflict. All four of these are really important because they could either individually or in some combination cause the stock market to go up to the moon to all-time highs, or it will cause the stock market to come crashing down back to earth in a full-blown recession. And with that, let's hypothetically say that the stock market is either crashing down or in a full-blown recession. And no, I'm not going to be like this or like this, because I'm going to be super chill and happy, because you should be as well, to see the stock market at great prices in these hypothetical situations. So the first strategy to take advantage of lower stock prices and to get the best return in the long run when the stock market makes a recovery back to all-time highs is to, first of all, relax, because everything is going to be okay. But seriously, the first strategy is called the DCA and Chill strategy, also known as dollar cost averaging or DCAing, is when you buy an ETF or stock in a fixed dollar amount on a regular basis regardless of the stock price. For a real example on what I personally do, my 401k is 100% invested into Vanguard's VTI. So if I allocate $400 to buy a VTI every 2 weeks on a Friday, then guess what? I will DCA or invest into VTI every other Friday, no matter the stock price. This is amazing because with dollar cost averaging, you don't time the market because you have spent more time in the market than timing the market. And dollar cost averaging also takes the headache and emotion out of guessing when the bottom of a stock market crash is going to occur. Because in reality, no one, and I mean no one, can predict the movements of the stock market in the short term, but hopefully in the long term, when you buy ETFs long enough, ETFs and even dividend stocks will go up and up, and then you make your profit that way from dollar cost averaging. The second strategy is called the Cash Savers DCA strategy, and this is what I do for my Roth IRA and my taxable brokerage account, which makes up a sizable amount of money for me at 23. What I do is I invest $1,000 every single week in my dividend, growth, and even broad market ETFs. And on the side, I am saving cash, hence the strategy being called a cash saver strategy. Now, with that cash that you saved up, you don't want to have it either physically or either in a bank checking account where it yields no interest, because that money is going to be losing money to inflation. So what I recommend is for you to have that cash either in a high yield savings account that gets a very high yield on your money. Now, what I personally do is I have my money tied up with VMFXX by Vanguard, which is a Vanguard money market fund that yields over 5% per year in interest and pays out these interest payments every single month. Now you can see that I've been receiving interest payments every single month of nearly $100 combined in my investing accounts. But VMFXX historically pays a lower interest rate since interest rates are so high right now. Why I save cash is for times like this when the stock market is dropping, and if the market is down big over 1% on any given day, instead of investing $1,000 per week like I usually do, I'm going to invest a lot more and go heavier to get the best prices and those discounts in the stock market to lower my stock price basis by dollar cost averaging, of course. And a lot of people were calling me dumb to just not invest that money in the stock market at all-time high prices. Now I did continue to buy my $1,000 per week basis, but like I said, I had this money saved in case of times when the stock market is going to be dropping very heavily or correcting itself. Now this is a smart way because even if you don't invest that cash, it's not like it's going to be sitting there doing absolutely nothing. It was yielding me interest payments every single month, risk-free, and that's what I do to make money either on the sidelines when it's not invested, or hopefully to dollar cost average in the stock market for capital appreciation. And you're also getting dividend payments because when the stock market goes down, usually the dividend yields will go up. So you will get a better price on your dividends in the long run. So it's going to be a win, win, win. Now, the real tip is to never stop investing because Personal Finance Club said that the market is always crashing by double digits, but the S&P 500 has returned 10% per year on average, so even during stock market crashes or recessions, the stock market almost always recovers and keeps on making new all-time highs. And guess what? One bad month for the stock market or negative 4% might sound bad, but over 1 year, 10 years, and even 30 years, the stock market just keeps on going up and up and up. So I don't understand why people get so worked up or nervous about a stock market crash, a recession, the world collapsing, because in the end, just put your money to work, invest in DCA, and just be in it for the long run, because one little drop in the market is going to mean nothing to you in the long run. When you zoom out and see the stock market's returns just keep on going up in the future. And if that's not enough to convince you to invest in the stock market in the long run, know that dividend stocks and most ETFs pay a dividend. So their dividend yields are going to be a bargain, and they will actually go up if you look at a dividend yield equation and if they are high quality funds and dividend stocks, making them very attractive investments to receive higher dividend payments in the long run. And dividend stocks usually perform better in recessions than stocks that don't pay a dividend. Lastly, Personal Finance Club made this image that says that Tom invested $500 per month for the last 30 years. He kept investing despite experiencing scary things like 4 bear markets, the dot-com bust, 250% plus crashes, high inflation, COVID crash, 2008, global pandemic, meme stock frenzy, 3 recessions, 9/11 terrorist attack, and Tom most likely did one of the strategies, probably the DCA and Chill strategy, over the long run, and now his portfolio is now worth over $1 million. And that's the power of investing in a stock market crash, a recession, or even a bear market. You just continue to DCA and chill and just ride the waves of emotions and just buy your portfolio for the long run, because eventually the stock market will eventually go up and up and up back to all-time highs, and this little dip or even a big dip is going to mean nothing in the long run. And there's way more important things than the stock market, like your family, your friends, and your mental health, in my opinion. So keep that in mind, guys. Now, if you guys like this video, please give it a like because this cute puppy did. And right here is going to be a video on how to invest in ETFs in a regular market, like at all-time highs. And right here is going to be a video on how to invest in ETFs for beginners. Now, hopefully you guys have a good rest of your day. Continue to crush in the stock market and take it easy. Peace. We're going to do the thumbnail. Okay. I can't do it, bro. I can't do this, bro.